Morning, everyone. This is Mihai from pipcenters.com. Can you guys hear me? Sound test. Is everything all right on your end? Do you have sound and chart? All right. Thanks, Carlos. So they are both okay. We can get started. All right. Thanks, Alinda. All right. This is London session scenario, guys. We're looking at pound dollar and pound yen. We're going to analyze a bit the market from an Elliott Wave perspective. We're going to identify key levels in the market, and we're going to use the rainbow template to possibly identify scenarios, trades for today, for short term and for swing trading as well. We're going to start with pound dollar, guys. I'm long from right about here, 55.31. Right now I see price at 55.34. So I just wanted to let you know the position in the market right now. I'll get to why I'm actually long at this point. I had an entry earlier at 55.60, but it was very, very small. I entered now with a normal regular position at 55.31. We'll see how it goes. And what follows, I'll explain the setup. It will become clear. All right, we're looking first at pound dollar. A quick look at the longer term picture. Okay. Now this was the trend that we were trying to identify for some time while the market was inside this range, and we now have actually a break of this supporting trend line and the tendency towards the downside. This move right here also recovered, retraced more than 75%. It's actually very close to 100%. So I'm looking at a longer term bearish move. The rainbow is also confirming that the market dropped, pulled back from this horizontal level. I'll call this a key level for midterm, the 153 area. Okay, a triple bottom at this point. It pulls back towards the rainbow. It's actually at the confluence of the moving averages, right next to the 200 moving averages, and it started moving down. Okay, slowly with the candle from 2 weeks back closing outside of the rainbow, so reaffirming the bearish trend. Last week's candle slightly, it's actually a bullish candle that might indicate more consolidation within this area. But to see things from that perspective, we'll have to zoom in on a smaller chart. As far as this chart is concerned, I would say we are in a bearish trend longer term with 159, 160 as a barrier, but the absolute barrier is beyond the 78% of this segment. Okay, that's 60.63. So price shouldn't reach up at approximately 162. I'm usually using the halfway between 78% and 100%. I'm talking now long term. So that means for entries, aggressive entries that are not confirmed by a breach of 153, you will have to be as close as possible to the top of the rainbow, and stop should be somewhere in the 162 area. That's about 700 pips from where we are now. Okay, long term that it's not so much, but actually if you're entering at 156 instead of 153, 155, 154, that can make quite a lot of a difference from a risk-reward perspective. All right, just a quick short presentation of the long-term situation for those of you who are trading with that sort of charts, with that perspective in mind. I think for shorter term trading, what we most of us are trading, we will have to look on daily and lower. Okay, and there's something quite interesting going on. You'll be surprised maybe to hear that I'm going long right now. The market has been going down today, but it hasn't dropped that much. Actually, it's only 50 pips from the top, from the high of the day. I have this not really short-term perspective. Is a little bit more than short term, but I wouldn't say mid-term. I think you will see it in just a moment when I reach the hourly chart. Let's see what we have on the daily. Now this is the larger direction, and I would expect this retracement to hit somewhere back towards 159 based on the fact that the current wave is an ABC that looks complete. I'm saying it looks complete. That's all I can say right now. It's not confirmed complete. And this last wave, okay, I'm always watching the 78%. And last week, actually, I was ready to take out my short when the market approached the 78%, even though it was quite strong, the price action at that point, okay, and it looks very bearish, but I do not want to short against the 78% or to buy against the 78% right here. I don't like doing that because I know that risk reward wise it's not too favorable, okay. Bottom line is it stopped precisely at this 78%, but I wouldn't have known that until I saw this candle, this long white candle right here, Friday's price action, and this is what I'm basing the current long trade on. Still, this chart is a bit too big. I just wanted to present the overall picture, still a longer term, but I just it just gives a better perspective, this chart. Now this will be the formation I'm watching, okay? The retracement wave, okay, which right now, in my opinion, has a higher probability of seeing a 159 or at least a retest of 158 before dropping again. Remember, this is not long-term. Long-term remains bearish. So if you are trading long-term with this sort of perspective, you'll probably either short at 153 or short higher around 158 up to 159. Okay? Still short at all these levels if you are in long term, because in that case you can afford a stop around 162, and you should afford a stop that large. 300 pips long term is no big deal. That's definitely a reasonable stop for a long term position. All right? But if this formation doesn't play the way it's mentioned here, then we shouldn't see any move beyond the 78% of this way. All right. Of course, we're not yet anywhere close to 78 of this wave. We have just started to go up, but there is actually something that tells me we should be careful about a retracement, at least as far as this smaller wave is concerned. Okay, so what do we have so far? We have the longer term perspective short. That's not going to be useful, by the way, for the setup that I'm presenting from here onward. So that's simply for those of you who are trading long term with very large stops. Okay, and there's this beginning of a bullish pattern, but on the daily it's not so clear. Let's see the 4-hour chart. All right, now here it becomes a bit clearer what I wanted to show. Now it's this segment right here that gives me the today's trade. Okay, let me remove these to make sure that everything is clear. Okay, and now you guys can already see that the high on this morning's high was clearly higher than this top from Friday, if I'm not mistaken. Friday or Thursday in any way. 5577. Our high is 5592 today. Now, be that it be, it doesn't really matter that it didn't break this area clearly. In fact, it even convinces me that something's going on because it's a typical false breakout. Okay? Price reached above just about enough to take out the stops, possible stops right above the previous high. Okay, but it seems to be pulling back as we speak. All right, but the very fact that we are not in a lower lows and lower highs dynamic anymore gives me the probability of a wave evolving from this, and this being at least the beginning of an ABC bullish formation. Now this is what I trade for short term. Okay, I dare to label this A. It could be a 1, but it doesn't matter really from my standpoint. What I'm more interested in is whether this is an A or a 1. It should be the beginning of a new wave, of a new formation, and whatever price drops, it shouldn't drop below the previous low. Okay, so again, I'm using the 75%, the 78%. I measure this wave. I see where the 78% is, and I would put my stop somewhere beyond the 78%, but not necessarily exactly on the 100%, because the retracement should not be deeper than 78. From my experience, a retracement at 78% and drops below that 78%, even if it spends little time there, will eventually break and make a fresh low or a fresh high. So this is why I'm not putting my stops beyond the beginning of the move, but very close to it. Okay, like this, I gain a little bit in terms of risk reward. Okay, so the setup is pretty simple, really, since I identified that the market is no longer moving in a series of lower lows and lower highs, and this high is actually a higher high. I do not have a higher low just yet, but I'm waiting for it. Okay, I am already watching for my entries, and there are two ways to deal with this as far as my Elliott Wave entry patterns are concerned. Either I enter at the typical wave B target. Okay, according to the rules and guidelines, it should be somewhere around 38.2 to 50%, not bigger than 61.8. If this is a 1 and wave, the current retracement wave is a wave 2, then the pullback should be much deeper. But judging on the price action from very, very strong price action, I would say we shouldn't see even 61.8 before we move back up if this pattern works out. And this would be the target that I'm following, the wave C. Okay, the idea would be to either enter on the pullback, so I would try to take the price lower to get a better deal, okay, with stop not too far away, as you can see, and going for a target almost twice as big. Either that, or I just simply allow it to go down wherever it goes. I do not enter, and I take it on a break of a previous high around 55.90, 156 for a much smaller area, a much smaller target, but also a smaller risk. Okay, so according to this, the entry area would be somewhere towards the bottom of the rainbow, and we already had that. Let me zoom in. As you can see, so 31 was actually late entry for me. I should have entered around 5520, exactly here, exactly towards the bottom of the rainbow. Well, not really, because I couldn't have known. 5515. I don't think price hit 5515 today on the ask. Probably not. It doesn't matter really. It's just a question of maybe 5 to 10 pips. It's not really such a short term or a scalping setup, so it doesn't matter. 5 pips don't have such a huge importance, and the target is about 180 pips anyway. So there will be plenty of time to get our points. Now it's interesting how the rainbow behaved during all this while, because price went up very strongly up to the top of the rainbow, but it never really managed to stay on top of the rainbow until it gave the retracement. So I think so far it fits perfectly into the retracement scenario. Here's the trend line. This can actually be a retracement target, the trend line that breaks and then is being retested, the bottom of the B. Okay, let's measure this with a fib. As I mentioned earlier, I would look for 38.2 to 50%. 38.2 was already hit at 55.16. Yes, it was. So we already have 38.2, the typical target for wave B. If price goes up towards 55.85, 156, then you know you have a confirmation because the 38.2 typical target was hit. At the time you will know. Right now you don't know if this is the actual end of the retracement because price is still going down. As far as we can tell, we are still in very short term on this corrective wave. However, if price hits even 1 pip above the previous high, you will know that this formation is over. You can clearly tell how big it was. 38.2 will fit the exact pattern of the wave B. So then you have higher probability for your ABC pattern and higher probability for a long that would work with stop right at this bottom, wherever this bottom is at the time when price breaks. Okay, so let me just mention these two setups and mark them down here. First will be a long at, let's say, 5525 to 5525. Let me just include this target just in case we drop some more today. 54.90. Actually, down to 54.85 is still okay. Okay, stop loss at 5406. Let's just make it 5404. All right, target around 56.75. I'm not giving the exact target that I find on the waves. I'm always using 5 pips or 3 pips or 10 pips lower, just to allow for a worst case scenario. Now this looks pretty good as an aggressive. Let me just mark this as an aggressive entry. Okay, it's aggressive because we're actually buying while price is still going down. The smaller charts will show you that price is going down, has been going down the whole morning, but we are thinking of buying because we're looking at the bigger picture. Okay, anywhere below 154, this scenario fails, and this is where I would know that I should not continue buying. Now, if you enter an aggressive trade, an aggressive setup, you should be as aggressive as possible, meaning that you're basically looking to buy a bottom, to catch a bottom. So the lower price gets, the better it will be in terms of risk to reward. The bigger your reward will be, the smaller your risk will be, and basically the risk in terms of probability of success does not increase too much because you are still within the same pattern as far as these scenarios go. Just the fact that price dips maybe 20 pips from here or even 40 pips from here will not change anything. It will be within the same pattern because I cannot predict where the retracement goes. As long as it's within the acceptable limit, it's still a retracement, and this is still the path to follow for today, at least as far as I can tell, based on my scenario. All right. If you are trading the other one, if you prefer being more conservative, and if you are looking for a higher probability of success, you will be buying at 5590. 5590, sorry, with a stop at bottom of correction. Okay, wherever that bottom of correction may be at that time. Could be already the low that we have around 15, or it could be lower. Maybe the market dips a bit more today. We don't know. All right, same target at 56.75. Okay. Now this one has a higher chance of success because at the time when you enter, the correction is already over. You do not have to predict anything. You know for a fact that this was a corrective wave because you can tell that the newly started wave is larger than what you just saw. So there is no chance of this wave being anything else. Yes, Solomon. Mm-hmm. Yeah, because you know why, Solomon? The pattern is like this, okay? The pattern is like this. This is my ABC pattern. And I'm trading two possible points, okay? Either I go as much as possible in this valley and try to go for the entire move up, and I put my stop right at the bottom because I do not know how much it's going to retrace, but I know that it cannot retrace more than 90%. Because if it does, I'm wrong, and if I'm wrong, I'm out, okay? But if it breaks, okay, it's not necessarily a new. Hold on, let me just put it like this. Okay, it's not a new move. It always was a new move, but it's where it confirmed to be a new move. Because within this wave theory, you know, that the Elliott Wave theory is actually trying to predict price action. It's not lagging. You can be ahead of the market all the time if things work out for you. So it's a move that already started. You have a hint. This should be a new wave. And this is what I'm actually considering right now. I'm long at 31, okay? 5531. Of course, what I want is for this to be the start of a new wave. I do not want price to dip any more than this. So as far as I'm concerned right now, this should be a new wave. But if it breaks the earlier high, it confirms that I was right. It doesn't mean that the trade cannot hit its top or, you know, just be a loss in the end. But it just tells me that whatever I was considering in the beginning is right on track, and my trade is right on track. So I can add to the trade if I want to, okay? And I know for an absolute fact that this segment here, or in our case here, you see, when price hits this line, you know that this segment right here is smaller than the one before of waves where price goes in a series of higher highs and higher lows. This is a correction. So if it's a correction, go with the real move, not the correction with the impulse, with the actual direction in the market, which in this case will be long. But if it doesn't break, then there's always a suspicion that this is not over. Okay? Might go a little bit deeper. Who knows? Maybe it will make a correction like this, a complicated correction. You never know. This is why I consider this to be aggressive, because you're trying to guess. You play always the probability game. The probability of success of this trade, the one that I took, is maybe around 50-50. I have a much bigger target to get than the loss that I would take if I'm wrong. So this is what makes the system right in the long run. But I think the probability is about 50-50. If you take the second one, probability maybe goes to 65 or 70%. But the risk to reward is not that great anymore because you only catch this small segment instead of catching the whole thing. So it's a give and take situation, I suppose. You cannot have huge risk reward and at the same time huge probability of success. Because if that's the case, you would only trade those patterns. That would be too good to be true, and you would only trade those. But from what I've been seeing so far, it doesn't happen that way. Either it's very, very risky. Sometimes, by the way, you trade a 78% just because it's a 78%. The probability is much less than 50%. But if it works out, you obviously don't put a too large lot on that trade because you know it's going to be a very risky trade. Okay, but if things work out, the entry is fantastic. Yes, Stalin? Mm-hmm. Mm-hmm. You know what, Stalin, what the problem is? Um, there are two directions of the market, up or down, and people are speculating both ways. The problem is sometimes we're not very clear when someone gives an opinion, what is their time frame? Because I gave one bearish outlook at the beginning of the session, and now I'm saying long, you know, and they both coexist without any problems because that was a really long-term view, and this is a short-term to maximum a few days, maximum 2-3 days view. So I think overall, I really don't want to comment exactly on a fundamental side because I'm not really trading using fundamentals, so I can't really say that my opinions matter in that respect. I'm generally very technical, so from a technical perspective, I can say that it can very well go up, let's say, to 5,680 and still be very bearish. Okay, and the dollar could well strengthen by the end of the month, while we can still take something on the upside. And by the way, you might want to scalp it short right now as we speak for a target, let's say, of 55.10, which is only 25 pips away. Because right now, for the next, let's say, 15 minutes, the probability of shorts is higher than the probability of longs. So if you're trading with only this small perspective in mind, one moment, my chart has a bit of a delay. Guys, can you please confirm that you can still see my chart and hear me well? Having some issues here. I'm not sure if everything is okay on your end. Oh, okay. Thank you, G. Thanks. All right. Seems all right. Yes, indeed. That's where it started. But in my decisions, basically. Oh, all right. That's okay. I understand now what you mean, Tallinn. No, it's not. It's not. That's exactly what I meant earlier when I said that whether it's pushing up from here at 55.15 or it goes lower towards the breakout point somewhere around 54.75, it wouldn't make much of a difference. But one thing, if it goes to 54.75 and stays there for a few hours and it looks like it's very heavy, the rainbow will tilt a little bit to the downside. And in that case, I would say maybe we should start being less aggressive because it becomes, let me put it this way, if you're already long, you keep to your plan and you keep your stop where it is because it's only at this point where the scenario would be contradicted. So that's very clear. You do not have to panic, and it's a better entry. You would risk only about 70 or 80 pips compared to approximately 200, 250 that you would get. So that's pretty good. All right, and that's no problem. And it's not too low as a retracement level. It's just that Tallinn at this point, I don't want to complicate the analysis too much, but because I like sometimes to leave some options open. I don't want to determine exactly whether we're dealing with an ABC or we're dealing with a 1, 2, 3, 4, 5. Things could be different in each case. But since they both indicate longs after a retracement of either 50% or 61%, it doesn't make much of a difference. It's still the bullish move that I'm looking for. But if it breaks the previous high, then I will analyze and I will have more data to say, yes, it is a 1, 2, 3, 4, 5 because it dipped too much to be an ABC, and the strength of the move, it depends also on the price action when price goes up. For instance, if right now we're hitting 156 within 1 or 2 candles, okay, about 50, 60 pips very quickly, it will tell me price action is very strong and it resembles that wave 3 dynamic, okay, strong, sustained, a lot of volume and pretty much one direction. So that will tell me we are going to see much higher level. We're going to see 158, 159. But if price keeps going up and down and up and down and breaks a little bit and comes back and breaks a bit more and comes back, that will tell me that yes, we might be in an ABC because it just broke above the previous high, but it fails to give indication of sustained price action. And in that case, eventually, it's the bears on the daily chart that will decide where the market is going. Price action is actually a very important indicator. And when you're trading like this, when you're trading with level, it's important to use something related to price action dynamic, because the levels don't tell you anything about how price got there. And even the shape of the candles, you simply trade the level. Those scenarios that I presented to you guys, these two scenarios are simply based on level, wave and level. So they are based on the fact that if, for instance, this level, this 154.04 is hit, then this scenario is wrong. The whole point is to actually make sure that if you are exiting a trade based on the wave, you're exiting because you're wrong, not because you're afraid, not because you're too greedy, not because I don't know, you just don't feel like trading it anymore. No, you exit because it's wrong, and because the market proved you wrong. There's nothing to be ashamed of, but that's the purpose of these levels and of using these fibs in a pretty precise way. And of course, well, if for instance you hit the previous high, market breaks out, sometimes I'm doing this game of scalping. I know I'm trading long. I'm only trading long, but I keep going in and out, in and out, in and out, using, of course, the same direction confirmed by the setup. So I'm basically long. But if I'm in front of the chart and I feel like trading those small moves, I switch to a 5-minute chart and keep going in and out and in and out. And sometimes you get much more than the distance traveled by price, because you catch 5 pips here, 2 pips there, you lose a few pips sometimes, but in general you make money because you're trading in the right direction. Okay, if it's not the right direction, then all the trades, regardless of their levels, hit the stop and that's it, and then you're out, and then you know that you're on the wrong side of the market. It's definitely not a game of adding to losers just like that. You add to a trade that's against you only within a certain distance, only when all the parameters of the trade are still valid. Mm-hmm. Yeah, gee, that's pretty straightforward question. Yeah, there is, but there is no way to not be wrong. I haven't found this recipe for 100% winning trades. Actually, my probability is not even close to 90. I think I have about 65%. But I'm pretty happy with that. Um, Listen, G, it depends on how you trade. Okay, if you are scalping, and basically these 4-hour charts don't interest you much, then you must not trade unless you are certain about the direction. About certain. Well, again, I'm using a word that cannot be true in trading. Unless you have a high probability, you are very confident that you're in the right direction, then you cannot trade. If you are trading long term, then your confidence is given by the long term analysis. So, for instance, in my case, it would be a short, and that means I would only short. Okay, I would short at levels that I find interesting and where the long-term analysis fits the short-term analysis. Okay, and if you're trading based on levels and directions, then you don't have to stop trading until you see the trend, because right now, for instance, I don't have to see the trend going up. I know this pattern. I've seen it many, many times before. So I'm perfectly okay in risking my money at a certain level with a certain exposure, okay, knowing that it's aggressive, okay, and not going overboard, because when you know it's aggressive, you know to lower the exposure. And you know that if you are right, you will know pretty soon. For instance, I'm in at 55.31. I'm 10 pips in profit, which doesn't mean anything. But if I go 35 pips in profit, I know that I am right about that entry, and I can double up. I can add to the trade, move stop to break even for the first entry, so I can start being building up a really good trade with a large lot while I'm winning. So I don't have to risk much when the market is still here within this area when I do not really know what's going on. But not knowing what's going on is not necessarily that bad. What I find to be bad is to exaggerate your exposure when you don't really know if this is going to be, if the risk is too large. So basically keeping a balance between risk, exposure, and probability. The higher the probability, the higher should be the exposure, and vice versa. Not the other way around. And one of the things that I see all the time, and I admit I've done it, and sometimes I still do. I'm not really losing much money because I'm not exposing that much, but I still expose a lot, given the fact that I know this mistake. I've done it before. I add to a losing trade. For instance, let's assume that I'm right now long actually at 5531. If it drops to 54.90, I would add a little bit more, and I would be exposed, let's say, 60% or 70% of my usual trade. And it's still not going up, and it still drops, and it drops to 54.65, and that's very, very close to my to the point where I have to abandon this trade, and I add a little bit more there. And then if it hits 78% at 40, I add some more. I shouldn't, because the more it goes down like this, and the more my trades are going in negative, the more I should get the point that whatever I'm analyzing is not really in tune with what the market is doing. So if I was wrong once, I can be wrong the second or the third time, and I can be wrong the whole day. And it happens many times. When I'm right the whole day. And when I'm wrong, I just tend to be on the wrong side of the market all the time. So giving up is a good idea. The point would be, ideally, if you're trading this the right way, I should not add to the trade unless it hits around here at 70, and that should be a small exposure as well. It will average 31 with about 70, so my entry will be around 90. That's reasonable. That's right, because for some reason, G, we do not like the negative balance. And it's silly, because we're looking at the equity dropping. The equity is the money that we really have, but for some reason we're concerned about this thing called balance of the account. Who cares? The money that you actually have is in the equity. We shouldn't even look at balance at all. But we do not like closing trades for minus. And I can tell you that since I've been trading, I've been closing trades in negative a lot, and I do not hesitate to close a losing trade because I don't really care. I don't see any change in equity when I do that. So it doesn't hurt me at all. It doesn't bother me. I look at equity all the time. So closing a losing trade is giving me absolutely zero pain because of that. And that's why sometimes when you're looking at the equity, you get the real picture. If you're looking at the balance, you think it's okay, but the trades are going against you and keep going against you. And it's not okay, really, but you're brainwashing yourself that it's fine. We went a little bit over time with GU. Okay. Won't have much time for GJ, unfortunately, today, guys. We're going to have to stop very soon in just 5 minutes, so I'll have a look at the rainbow. Now, one thing I wanted to point out about this is the rainbow pattern. The fact that the rainbow is giving you a pretty good trend indication. You don't have to go so far, and the rainbow is different than the waves. And I love that about this because I get a different opinion. It's like talking to somebody else who trades something else. The rainbow is lagging. These are lagging indicators. These are moving averages. So I know for a fact that it will give me a different picture. And so far, the picture agrees. You see, the bottom of the rainbow is right at the 38.2 line. So it agrees with me that most likely we're looking at a bounce from here or some more consolidation. And if there is more consolidation, then it could be a problem. It's not negating the setup, but it's just reducing the confidence. Is sound back now, guys? Sound test? Oh, all right. Okay. I lost you guys there for a while. All right. Before closing the session, I want to have a look at GBPJPY as well, but I'm gonna look only at the rainbow. Okay, the rainbow and the rainbow alone. Going into the waves would be a bit too complicated at this point. Okay, we're gonna start on the daily, very quickly plotting the key levels on each time frame. Let's see if we can do this in 5 minutes. All right, only top here on daily. 4 hour has a top. All right. Look at how the top of the rainbow gave the nice aggressive entry for short at a point where you get a very, very good risk to reward. Quite nice. All right, here you go. I'm marking, guys, the top of the rainbow or the bottom of the rainbow, whatever I see in on each chart. This is a bit of a complicated rainbow. I'm going to mark this level too. This will be the bottom because price and the red moving averages are actually in an area where they recuperate. Okay, they go back up towards the green. The yellow should be here, but instead it's the green. So I find this level to be relevant, actually, as a possible support or resistance. 30 minutes. I will use a green color. It's really amazing how a simple map built like this can give you the picture of and even a good entry, a good trade. Here you go. And the 15 minutes chart. Top of the rainbow around the same. You can see the confluence of levels. And, well, it's a bit complicated here, but I will just leave it like this. Okay. And now we see, we're going back on the 1 hour chart, and we see what the key levels are and what the direction is. Actually, price is below the hourlies, okay? The 30 minutes, the 15 minutes, the 4 hour, and if you look far enough, the daily, okay? That means we are in a bearish trend almost everywhere. But the key levels, the ones that will probably prove relevant for short-term trading, are these: 122.90, 123.20. So basically what I see right now as an interesting trade, just have to give this very quickly, is shorting while price is moving up towards this 122.86. I think even here, short at, let's say, 122.80. Okay, the stop would be hidden behind all these levels. Okay, that's actually the key of trading the rainbow, to hide your stop all the time beyond what you see as key levels, and especially if these levels coincide on several time frames. So that would be 123, I would say 123.30. Why am I not using the exact 123.12? Because the market many times just spikes, especially on the smaller time frame, especially pound yen tends to spike a lot. So you do not want to be out on a spike. You want to be out only if price settles above 123.20. What I do sometimes is simply have my stop really higher up at 123.50 and close it manually when I see that it closes in the area where it shouldn't. Okay, so price actually should spike to 123.15, maybe 17, maybe 20, but close back below 123.10. If it does that, then we should be fine. That's a pretty good 40, 50 pips risk. And the target, I would use the previous low and this support area, because I don't really see it as a well test. It hasn't been tested so well. 122. Let's just put 10 pips above that. 122.10. Okay, 122.10. Let's see if this works. Yeah, actually it does. It does. Because it's a 70 pips trade, a 70 pips target for about 40 pips risk, and we are with the trend, and we have the key levels to protect the stop. So I think this is basically the only setup that I would like to point out for short term. I wouldn't trust this long. Maybe I'm wrong, but I wouldn't trust it. Okay, the yen pairs might have more to say to the downside. And of course, if things don't work out, you know that somewhere around 123.20 you have to get out. But if it continues, I'm actually quite sure that we will see a reaction starting with 122.90 and up to 123.12. These confluence levels rarely fail. Let me just show you something, guys. This is how I use my system to find these interesting levels. Check this out: 122.97, 123.04, 123.03, 23.12. So I know these levels without even looking at the rainbow. I know there's a confluence. So I know that with a good short signal on the signal system, with a volatility filter giving me an okay to trade, and this confluence, I have a trade set up. And it's valid for... All right, euro dollar. Let's just look at the system since we're here. 122.22, 26, 26. Okay, there's a confluence level here. Okay, and I see a support level at 21.89. So there's also something, I'm going to point it out very quickly. Oh, this would be the chart that I sent today to my members. Can you guys see my chart? Just one moment, let me make sure that it's... All right, can you guys see the chart now? Now, this was my opinion about euro dollar today. And even as the euro dipped towards the 78%, as you can see, it can still go up. But oh, you can't see. Okay, reloading the camera right now. Now, this was my view of the euro dollar before London session. Okay, I traded a bit short, but I have to admit that I did not catch this. I caught a very small area of about 20 pips from the top around here because I was trading with a rainbow. Anyways, bottom line is, you see the 4-hour chart, you see that the 78 has not been broken. So, Humrahi, I would say, euro dollar if you want to buy the euro dollar now, it's dangerous because clearly the euro is not in a good shape. You look at euro yen, you look at euro pound, things are not working out well for the euro. So I'd rather stick to pound dollar or to Aussie dollar if you are thinking about buying against the dollar. If you are thinking about selling these pairs, I'd rather sell euro dollar because of the weak euro, and only when it breaks this 121.70, 121.67. But to be honest with you, I don't really see it going too far from there. I think it's a good short-term trade for about 20-25 pips, and if it hits 70, it will probably hit 40 in no time. But that's about it. That's all I can say, because apart from that, it just seems like the euro might find some support here. There are some reasons on the weekly and the monthly chart I cannot go into right now because my time is really up. But bottom line is, for the euro, I would do two things. Either you buy now very aggressively, but you keep a very, very tight stop. Very tight as in 21.70. Really tight, 20 pips. And you hope for the best because really that's what we can do. It's not really the time to buy. Or you just sit on your hands for a while and you see if it breaks 21.70 and then you short quickly with a pretty tight stop. It shouldn't go up much. And then you catch about 20-25 pips. It should be a safe move. But I would stay away as much as possible from buying the euro. And instead, if you really want to buy, why not look at the pound dollar, which is doing much better. And we have much better arguments for it too. All right. I have to stop here, guys. Thanks a lot for your participation today. It was fun sharing these patterns and discussing the market. If there are any questions, let me know. Just quickly. All right, this is my website address. You can actually find the live data box for Aussie dollar this week. Feel free to use it and to try to understand the system and to use the levels, especially the levels. And if there's any question I didn't answer, feel free to contact me via email. Also, if you want the rainbow template or anything else, no problems. Just drop me an email. Thanks again, guys. I'll see you all next week. That's right. Thanks, FX Street. Have a great week, guys. I'll see you all next Monday.